Hi, it's Greg Bavitas with Constitution Investment Advisory and Portfolio Management. I have an earnings update for you on Q2, but what we're going to do to provide perspective on these Q2 numbers, what I'd like to do is look at earnings results that go back 1 year, compare them to the most recent fully reported quarter, which would be the quarter that ended Q1 at the end of March, and then compare those numbers to the numbers that we're looking at here that have come out thus far for Q2. The reason I want to go back 1 year is, of course, if you go back 1 year, that brings us into the heart of last summer's pandemic. The numbers, of course, as you could imagine, are not going to be as good, but it's the improvement in the numbers that I want you guys to see that I believe are very encouraging and that I believe speak to the breadth and depth of the recovery here that we're seeing. So as we start, I want to mention that the data that we will showcase is powered by Refinitiv and their flagship workflow solution, Refinitiv Icon. It's a great platform, and thanks to them for the use of their platform here in this video. And as we go back 1 year, I don't want to assume what you may or may not know, so I do want to review the type of information that this screen is conveying to us. On the left side there, you'll see the different sectors of the S&P 500 with the bar graph next to it in blue that shows the percentage of companies that have reported. Now, this period that we're looking at is for a full year. It takes you back to June of 2020 and brings you up to May of 2021, and it includes companies that had a fiscal year ending in May of 2021. So again, we're going back 1 year, and if I had to draw an analogy to the columns to the left of those sectors, or to the right, excuse me, of those sectors of the S&P 500, you're looking at the percentage of companies that either beat, met, or missed earnings expectations. The companies that beat earnings expectations are depicted in green. The companies that met earnings expectations are depicted in white. And the companies that missed expectations, or the percentage of companies that missed expectations, are depicted in red. Likewise, on the column to the right of the earnings column, we have the revenue column. And again, companies that missed analysts' revenue expectations are in red. Companies that met analyst revenue expectations are in white. And the companies that beat analyst revenue expectations are depicted in green. And the reason we really like to look at this, of course, your revenue is your top line. That's what companies are taking in for goods and services that they're selling. Your earnings, of course, equally, if not as very important as well. That's what they're bringing to the bottom line. You might have heard that referred to as EBITDA, right? Or earnings before interest, taxes, depreciation, and amortization. Well, it's what you're bringing down to your bottom line after all that overhead is met. And again, if I had to draw an analogy to these 1 year results, I maybe, being a former teacher, if I were to look at this as like a report card, and my child came home with a report card that looked like this with some C's and D's mixed in there with maybe a few B's, maybe we're not as happy with this report card. And again, we're going back 1 year, so this is taking us to the heart of the pandemic. We have those different sectors of the S&P 500 listed there, starting with energy, going down to basic materials, industrials, consumer cyclicals, non-cyclicals, financials, healthcare, technology, utilities, and real estate. And again, when we go back 1 year, we see here energy, only 65% of companies had been beating on earnings and only 61% beating on revenue. Basic materials, 73% beating on earnings, 77% beating on revenue, and these are the C's and D's that I was talking about or alluding to before. Industrial companies, 80% beating on earnings, 73% beating on revenue. Consumer cyclicals, 73% beating on earnings, 70% beating on revenue. Non-cyclicals, these would be your staples companies, which actually saw a lot of sales, right, during the pandemic. Your non-cyclicals, though, only beating earnings at a clip of 63%, 75% beating on revenue. If I had to pick a pandemic bright spot, we all know that period was very dark. It would probably be financials, healthcare, and technology. These were three sectors that, especially technology, right? Three sectors that performed very well during the pandemic. For healthcare, 77% beating on earnings, 83% of those companies beating on revenue. Technology, a big pandemic bright spot, 88% of those companies that reported beating on earnings, 88% they matched beating on revenue. Utilities and real estate, if there were two sectors that were maybe a little worse off than the other sectors, if I had to pick two, would probably be utilities and real estate. Again, an F here actually for utilities, only 54% beating on earnings, 14% beating on revenue, 69% in real estate beating on earnings, 52% beating on revenue. And these were, well, utilities, of course, a regulated industry. And with all the shutdowns that we had last year, right, less power being used. So, that didn't help. Real estate took it on the chin as well. You got a lot of companies out there kind of reevaluating their real estate footprint. Hey, do we really need all the square footage that we have leased right now? Should people be working from home? So we see there, again, if I had to pick two that were maybe not quite as good as the others, would be utilities and real estate. But now that we've looked at the earnings results going back 1 year, and again, they're not that pretty, let's get a look at the most recent fully reported quarter, which would be Q1 of 2021, which ended at the end of March, of course. And when we look at those numbers, we see improvement over the numbers from a year ago. Again, I believe speaking to the breadth and depth of the recovery that we're in. So let's get a look at our Q1 results, and let's change our screen here. Okay, so now we've changed our window on Refinitiv Icon, and now we're looking at the most recent fully reported quarter, Q1, which ended in March. And if you compare these numbers to the numbers we just looked at, again, you're seeing improvement clear across the board in every sector of the S&P 500. And remember, column on the left showing the percentage of companies that have reported. The column to the right of that showing the percentage of companies that beat, met, or missed earnings expectations. The column to the right of that showing companies that beat, met, or missed on revenue expectations. The percentages of companies that beat on those expectations. When we look, energy, which a year ago had only been beating at a clip of 65% on earnings, 61% on revenue, energy improves from 65 and 61 to 91% beating on earnings estimates, 83% beating on revenue estimates. Basic materials, which had been at a clip of 73% beating on earnings, 77% beating on revenue, that improves to 85% beating on earnings. A little slip in the revenue from 77% a year ago to 73% beating on revenue, but again, a greater percentage of companies in that sector beating on earnings, improving from 73% to 85%. Industrials, big improvement here on both sides. A year ago, they had only been at 80 and 73. The most recent fully reported quarter now, 89% beating on earnings estimates, with 79% beating on revenue estimates. Consumer cyclicals, they had been at 73 and 70. Now, beating with that, again, the most recent fully reported quarter, 90% beating on earnings estimates, 79% beating on revenue. Your non-cyclicals, which again, that's your staples companies, had been 63 and 75. Now 82% beating on earnings, 74% beating on revenue. The pandemic healthy spot, right? Financials, healthcare, and technology, as good as those had been during the pandemic, even those sectors showing improvement. Financials had been at 85 and 77. They improved to 93% beating on earnings. with 80% beating on revenue. Healthcare had been at 77% and 83%, 77 earnings, 83% revenue. A little bit of a flip here, actually. 85% now beating on earnings, which is great. 72%, a little bit of a drop there in revenue. Maybe in Q1, not as many people spending on healthcare as they had during the pandemic. Technology, pandemic bright spot, had been at 88 and 88. Those numbers improve. Q1, 94% beating on earnings estimates, with 95% beating on revenue estimates. Utilities and real estate, which again had been that a pandemic, if I had to pick two that weren't really doing as well, utilities and real estate. Utilities had been at 54 and 14. This screen here, the most recent fully reported quarter for Q1, 54 and 14 improves to 71% beating on earnings with 61% beating on revenue. Big improvement there in utilities. And I would say some improvement here in a modest improvement in real estate. It had been at 69 and 52 for the Q1, still 69% beating on earnings expectations with 62% beating on revenue. So again, where earnings had stayed the same for real estate, some improvement there in revenue. And again, if I had to draw that report card analogy, right, when we went back a year, we're looking at season D's, the most recent fully reported quarter. We're looking at a lot of A's and B's with that two season there at the utilities and real estate. But again, from top to bottom, improvement from virtually every sector of the S&P 500. Let's get one more look now at Q2 to see what we're looking at here and compare these numbers to what we've just looked at. Okay, now that we've updated our screen here, we are looking at the most recent quarter now. This is Q2 that ended at the end of June. Remember, the percentage of companies that have reported are on the left. Then your earnings results are in the column just to the right of that. The revenue results just to the column to the right of that as well. And when we look at these numbers, we're basically seeing sustained strength from the Q1 numbers. Again, very encouraging, and I think speaks to the breadth and depth of the recovery that we're in. So when we look at energy, typically energy and financials, when a quarter ends, energy and financials are typically the first companies to report. We see 100% of the energy companies in the S&P 500 to this point have reported. So 100% of those numbers are in. And again, sustained strength in these numbers, 83% of the companies that reported beating on earnings expectations, with 91% beating on revenue. Very, very healthy numbers there. And again, sustained strength. Basic materials, 88% of those companies have reported. 78% have beaten on earnings expectations, with 70% beating on revenue. Industrials have reported. 96% of those companies have reported. Some strong numbers here with industrials. 87% beating on earnings expectations, with 90% beating on revenue. Consumer cyclicals, 74%, so not quite all of those companies have reported yet. 74% have reported. 87% beating on earnings. 85% beating on revenue. Your non-cyclicals, again, your staples companies, 68%. So we're still waiting for some data here from your cyclicals and non-cyclicals. In your non-cyclical, 68% have reported, 85% beating on earnings, 89% beating on revenue. Our pandemic powerhouses here, financials, healthcare, and tech, 98%. Remember, financials usually report pretty early, 98%. So most of those companies have reported. 95% beating on earnings expectations, 83% beating on revenue. Healthcare, 84% of those companies have reported. 92% beating on earnings expectations, 98% beating on revenue. That's a really healthy number there. Technology, still waiting on some results. 81% of those companies have reported. 91% beating on earnings expectations, 94% beating on revenue. And finally, to close it out, we've got utilities and healthcare, utilities and real estate, on the bottom. 86% of Utilities companies have reported 75% beating on earnings expectations, with 67 beating on revenue. 93% of real estate companies reporting, 81% beating on earnings expectations, 85% beating on revenue. So we're seeing maybe the Q2 number is not quite as strong, but we're seeing that sustained strength from Q1. We find it very encouraging. If you're following me on LinkedIn, you know my drumbeat has been economic data, earnings data, and virus data. We need all of those numbers to head in the right direction, of course, especially as they pertain to the virus. We've got our ear to the ground on inflation and, of course, economic data, not just inflation, but the employment numbers, paying attention to those very carefully. And earnings data, right? Earnings data, very important. We look at the big picture, the eye in the sky picture. We like that we're seeing depth and breadth here. And of course, there are the individual companies that we own that you own too, right? We're following the individual holdings that we have. And we're making sure that we've still got earnings growth, right? We've got revenue growth and positive analyst support. And again, we've got our ear to the track on a number of different crosswinds, but we're very encouraged by these numbers. We hope you are too. And again, big thanks to Refinitiv. The data that was showcased here today, powered by Refinitiv and its flagship workflow solution, Refinitiv Icon. Thanks a lot. Take care, and we'll see you again soon.